You click Apply. Again, another instant response. We're sorry. Or worse, your rate is higher than expected. You wonder, did all those applications just cost me the loan? Welcome to the invisible war on your credit file, where every application leaves a footprint called a hard inquiry and where careless behavior can quietly sabotage your borrowing power. Today, we expose the truth. Why multiple inquiries look like desperation to lenders, when in reality you were just shopping for a fair deal. We'll teach you the strategic moves that turn those dangerous dings into harmless data points, the legal fixes when someone pulls without permission, and the exact calendar playbook to protect your score while hunting for the best rates. This isn't guesswork, it's a tactical field manual for anyone applying for credit in 2025. Buckle up, your approval odds are about to change. Let's begin with the simple question everyone thinks they know the answer to. What is a hard inquiry? A hard inquiry occurs when a lender requests a copy of your credit report because you've applied for credit. This could be a credit card, a car loan, a mortgage, or a personal loan. It's your authorization that spaces your profile under a microscope. Hard inquiries are intended to reflect a lender's decision-making process. They want to know if you've been shopping for more debt or if you're a one-time applicant. That tiny line on your report signals risk, but there's a quieter cousin you should know: the soft inquiry. Soft inquiries happen when you check your own score, when a company pre-approves you for an offer, or when employers and landlords run background checks. Soft inquiries are invisible to lenders. They do not affect your credit score. Yet so many people confuse soft pulls with hard ones, and that confusion leads to panicked, destructive behavior. Here's the brutal truth. One hard inquiry might shave a few points off your score, often 5 to 10, sometimes less. But multiple hard inquiries within a short period paint a different picture. Lenders start to think you are credit hungry, a red flag. Why? Because someone applying for several loans at once could be strapped for cash, increasing the likelihood of default. Scoring models translate that pattern into higher perceived risk. Yet lenders also know that smart shoppers compare rate offers, especially for large purchases like a car or a mortgage. Scoring systems reflect this nuance. Rate shopping windows exist for a reason. When you shop for a mortgage or auto loan, many scoring models will treat multiple inquiries as a single inquiry if they occur within a specified window. It's called rate shopping protection. But here's the kicker. The window length and the rules depend on the scoring model and the timing. You must be surgical in your approach. Why timing matters more than volume. Imagine two applicants. One applies to 5 lenders across 6 weeks. Another applies to the same 5 lenders but within 7 days. The second applicant looks like a rate shopper. The first looks like someone desperately chasing credit. That difference in timing can mean hundreds or thousands of dollars across the life of a loan. Lenders and scoring algorithms reward consolidated strategic shopping and punish scattershot applications. Now let's bust the myths everyone repeats like lore. Myth number 1. Anytime I apply, the hard inquiry destroys my score forever. Truth. Hard inquiries stay on your report for 2 years, but their impact is typically concentrated in the first 12 months, and often only a few months. If you mindfully consolidate applications inside a rate shopping window, the system often counts them as one. If your score is already strong and your payment history is clean, the dip may be negligible. Myth number 2. All lenders use the same scoring model and treat inquiries the same way. Truth. Different lenders use different scoring models. FICO has multiple versions, VantageScore has others, and many fintech platforms use proprietary scoring logic. Each model and each lender may apply a different window for grouping inquiries. You should ask the lender upfront which model they use. This knowledge is power. Myth number 3. If I pre-qualify, it always avoids a hard pull. Truth. Many pre-qualification offers use soft pulls, but some services require a hard pull to provide a binding offer. Always confirm, is this a soft pre-qual or a hard application? Ask the agent or check the fine print. So what's the practical, tactical playbook? Let's turn these facts into steps you can follow. Step 1. Pre-qualify but confirm the pull type. Start every credit search with a soft pull pre-qualification. Most banks and card issuers offer a pre-approval or soft pre-qualification tool online. It tells you likely terms without affecting your score. Crucially, before you proceed to a formal application, ask if the next step will be a soft or hard pull. If the lender insists on a hard pull, stash that application for a time when you can consolidate it with others. Step 2. Batch your applications when shopping. If you're shopping for an auto loan or mortgage, mortgage, identify 2 to 4 lenders you want to consider and apply within the same window, ideally within 14 days. Though some scoring systems allow longer windows up to 45 days for mortgage shopping. This converts multiple hard pulls into a single scoring event. It's not cheating, it's smart shopping. Step 3. Know the scoring model the lender uses. A mortgage lender, a bank, and a fintech app may each use different versions of FICO or Vantage Score, sometimes older ones that treat inquiries differently. If a lender won't tell you, ask the broker or check underwriting documents. If you can match your application cadence to the model's window, you can protect your score. Step 4. Space out non-essential applications. If you're applying for convenience credit cards, store cards, or insurance offers, space them out. Don't open multiple accounts in a short period. The velocity of new credit harms perception, just like multiple inquiries. A good rule: avoid more than 1 or 2 new hard pulls in a 3 to 6 month period, unless they're accountable. Batched loans for rate shopping. Step 5. Monitor your credit reports weekly during shopping. Use credit monitoring or your Wise Consultant dashboard to track any new hard pulls. If you spot an unauthorized or suspicious inquiry, dispute it immediately. An unauthorized hard pull is actionable. If the lender can't verify authorization, the inquiry should be removed. That brings us to errors and disputes, because not every hard pull is legitimate. Unauthorized inquiries happen more often than people realize. Sometimes a lender performs a check before you finish an application, or a data entry mistake happens, or, worst case, a third party runs a pull in error or fraudulently. If you spot a hard inquiry you didn't authorize, here's the exact course of action. Document it: record date, creditor name, and any contact. Ask the creditor for proof of authorization. Many lenders keep records showing when and how you consented. File a dispute with the reporting bureau online and by certified mail, attaching your statement that you didn't authorize the inquiry. If the bureau validates the inquiry, escalate, file a complaint with the CFPB, and consider contacting the lender's compliance office. In many cases, an unauthorized pull is removed quickly, sometimes within days, but you must act fast and keep meticulous records. Let's look at the psychological game lenders play. Multiple inquiries not only lower a score slightly, they trigger manual underwriting or automated red flags. A loan officer seeing a cluster of recent inquiries might manually review your profile and ask uncomfortable questions. They might require more documentation, higher down payments, or deny the application outright, even if your numerical score is acceptable. So inquiries can cause secondary friction that no numeric score captures. Now, some advanced tactics the pros use. Use soft pull aggregators. These services check multiple lenders' pre-qualification offers using soft inquiries exclusively. Once you narrow the choices, commit and move to a hard pull only for the top options. Leverage rate locks. For mortgages, if you find a favorable rate, lock it. Don't keep shopping after you lock. You risk new inquiries that could change your position. Inquiries don't have to be your downfall. They're a tactical challenge you can beat. For a custom inquiry audit, a 90-day repair playbook, and one-on-one support, book a strategy call at wiseconsultant.com. Subscribe for more pro-level credit plays. Hit like if this helped and share this with anyone about to go loan shopping, because smart applications win better rates, not worse scores. Take control, shop intentionally, dispute aggressively, and build relentlessly. Wise Consulting Enterprise. We could help you in such.